Good afternoon and welcome on behalf of SEPS. This meeting to discuss, difficult issue. The spring forecast for the European economy. We have hearing it. I don't know whether it is going up and down, but we have hearing it going up and down as a result of what's going on in the US and our dependence on exports, whether it's true. That we'll have to see, but I'm particularly pleased that we have Alfred here, let's say Director of the Europe Department in the IMF, to present it briefly for about 15 minutes, and that we then have Martin and Cinzia to comment upon this, so that should provide for a rich debate. But also happy to see some former colleagues who work in the IMF department here, Jan, Martin and Matthias. So apparently we do our role as a think tank to train people to work in other institutions, apart from going to DG ECFIN and DG FISMA. They are going to the IMF offices as well, so which is a nice thing. Great to see that. And that's part of the role of a think tank, to train civil servants or future civil servants and to ask the right questions. So that's what we will do today, ask the right questions, but we'll first give the floor to Alfred for about 15 minutes, and then we'll see with Martin and Cinzia to comment upon this. So Alfred, again, great pleasure to have you here, and we met in the context of debates on Capital Markets Union, which is one of the aspects you will touch upon, but I think there is much more, I'm sure. Alfred. Please take a seat.
So good afternoon, and thank you, Carol, for the introduction, and SEPS for hosting this event. I would also like to extend a warm thank you to Cinzia and Martin for taking time out of their busy schedules, and to all of you for joining us here today. Europe has achieved much over the last 75 years. The economic miracle of the post-World War II period brought a rapid recovery in income levels. The great moderation from the 1980s to the 2000s, following the oil crisis in the 70s, offered stable growth and a declining inflation rate. And advances in regional integration, for example, through the Single European Act in 1986, and global trade helped lift productivity and income levels in Europe. The result was income per capita in advanced European countries growing by 2.5 times between 1960 and the end of the century, on par with the US. And Europe has shown grit when it mattered. Resolute policymaking helped overcome the double blow of the global financial crisis and the European debt crisis. And Europe stepped up again during the COVID-19 pandemic and the energy crisis following Russia's invasion of Ukraine. But more work needs to be done. The world is changing fast. Today we are confronted with a more shock-prone, uncertain, and fragmented world. This adds to a series of domestic challenges in Europe. Some are long-standing. The great European project remains unfinished. The population is aging. Climate change requires attention, and there's a worrying productivity gap with the most dynamic economies. Other challenges have become prominent only more recently, such as the need to bolster national and energy security. And in many countries, there is a limited fiscal space to meet these growing challenges. Europe must once again step up if it wants to preserve its prosperity. Kicking the can down the road will soon make it impossible to fulfill commitments to social welfare, climate action, and national defense. Delivering on this front is existential. Europe's economic and social model is at stake. The deteriorating external environment weighs on Europe's economic outlook. In our latest World Economic Outlook, we project global growth to reach only 2.8% this year, in part due to emerging trade and policy uncertainty. In the United States, growth is expected to slow to 1.8% from heightened tariff, economic uncertainty, and softer demand, while China's growth forecast is lowered to 4%. These numbers do not reflect the latest developments, which could mean lower tariffs than assumed in April when we made these projections. But uncertainty remains extraordinarily high and holds back consumption and investment. And this trade and policy uncertainty also led us to downgrade growth in Europe, despite some offsetting factors. Germany plans to ramp up infrastructure spending, and European defense spending is projected to increase significantly. For the euro area, we expect growth at 0.8% in 2025 and 1.2% in 2026. This is a reduction of 0.2 percentage points in both years since our January projection. Growth in the more trade-exposed CESI region slows by even more, reaching 2.4% in 2025 and 2.7% in 2026. This is a downgrade of 0.6 for 25 and 0.4 percentage points in 2026. High-frequency indicators and euro area GDP flash estimates, and here we exclude volatile figures for Ireland, they are consistent with our projections. So these are the first quarter flash estimates we are talking about. A word on inflation. Inflation is decelerating and approaching targets driven by lower energy prices and tepid demand. There are notable risks around the baseline. First, an escalation of trade tensions would further weaken external demand and increase uncertainty. Second, a reconfiguration of supply chains could impact activity and inflation. In our view, trade diversion to Europe from countries more affected by US tariffs is a small risk on aggregate. But it could lead to losses in export shares for specific sectors in some countries, especially those CESI countries with persistent real wage growth. A third risk is a delay in the necessary fiscal consolidation, which could reignite concerns about repayment capacity. So, how can Europe rise to these challenges and secure its prosperity? Europe needs an ambitious and concerted push to advance long-stalled reforms to boost growth and economic resilience. Action should be carried out both at the EU level to deepen the single market and domestically to make product and labor markets more growth-friendly. The forthcoming EU budget for 2028 to 2034 should support and incentivize the reform push and meet the growing need for European public goods. This reform effort must be anchored in a steady macro policy response and open trade policies. Let us now look at some of the details. Starting with macroeconomic policy, central banks should continue to normalize monetary policy while remaining focused on durably reaching price stability targets. The ECB should lower its policy rate to 2% this summer and maintain it there, barring major shocks. In CESI countries where inflation is still higher and more persistent, central banks should ease cautiously. Moving to fiscal policymakers will have to find ways to accommodate rising spending needs in a sustainable way. In countries where public debt is already high, consolidation is warranted and reprioritization is necessary to accommodate new spending needs. Regarding trade policy, Europe, and indeed everyone, needs more trade. The global trade regime has shifted, and some reallocation of resources and reconfiguration of value chains appear inevitable. At the same time, it is important to not overreact. For example, while US-China tariffs may divert some trade to Europe, we estimate that even with April's high tariff rates, the aggregate effects would be small, to the order of 0.25% of EU GDP, or about 3% of extra EU imports. If the latest tariff de-escalation between the US and China would hold, these effects of trade diversion would go down and would impact European imports by 1%, so a relatively small number. Although the effects could be more pronounced in certain industries, it is far from clear whether safeguard measures are required. Where measures are deployed, they should align with WTO principles, be time limited, and they should be clearly communicated. Europe should avoid tariff escalation, and so should everybody else. And it should protect people, not stand in the way of structural change. Let me now turn to the structural policies that Europe needs to boost growth and resilience. I will focus on EU and domestic reforms with the highest urgency and with the highest potential. I will emphasize their complementarity and the need to pursue comprehensive reform packages to enhance political support. I will also highlight the key role that the next EU budget can play in supporting the reform effort and ultimately secure Europe's prosperity. First, it is high time to reboot the EU single market. Europe has come a long way, but the EU single market remains far from complete. For instance, it can take up to 6 months for an EU worker who relocates to another EU country to be legally employed there. Large differences across bankruptcy procedures discourage cross-border investment, while having national stock markets introduces vast inefficiencies in the allocation of capital across the continent. This fragmentation increases cost and it hurts business dynamism and growth. Full integration of the single market would yield tremendous benefits. Our modeling work shows that a 10% reduction in barriers to intra-EU goods trade and multinational production would lift GDP by around 7%. But we need to take concrete steps in this direction. In a forthcoming paper, we list 4 priority areas. Adopting high-quality insolvency rules within a 28 regime for firms to simplify the regulatory landscape. Advancing the capital markets union by boosting venture capital and equity investment. Increasing labor mobility across Europe. And the final part of the package, better integrating the European electricity market. Presenting these reforms as a package may increase the buy-in from member states that see benefits in some areas more than others. And this remains realistic on feasibility in moving forward. What we find is that just this package of selected actionable measures could raise EU GDP by approximately 3% over the next 10 years. That would be a significant down payment on the full potential gains from completing the single market. Second point, advancing EU and domestic policy actions together would magnify the growth impact of reforms. In another paper to be published in a few days, we highlight the significant potential gains from domestic structural reforms. A package of reform priorities addressing policy gaps in labor markets, business regulation, and credit and capital markets could boost output by approximately 5% in advanced European economies and up to 7% in CESE countries over the medium term. A coordinated effort at both domestic and EU level reforms would yield benefits that exceed the cumulative returns from isolated actions in the 2 areas. So, do EU level reforms, combine them with domestic structural reforms, and the growth dividend will be higher than what we are forecasting. For example, advancing the capital markets union would boost the effects of domestic initiatives to support innovative startups, and improving skill levels at the national level will amplify EU research and development efforts. Across all areas, think smart and think big. Structuring reforms as packages in which everyone can see direct benefits can enhance domestic political support and facilitate successful implementation. Third, the EU budget has the potential to be a powerful lever for advancing policy priorities across both the European Union and the member states. The EU's multi-annual financial framework, MFF, has helped tackle shared challenges, promoting economic convergence through cohesion policy and strengthening resilience via the Next Generation EU. To meet existing and emerging challenges, we suggest that the 2028-2034 MFF be revamped along 3 key lines. Prioritize European public goods. The EU budget should allocate more resources to key areas of shared strategic interest, such as research and development, the clean energy transition, and energy security and defense. These are domains where collective investment delivers greater efficiency and cost savings compared to national level efforts. To meet these needs, expenditure targeted at European public goods would need to increase from 0.4% of GNI to 0.9% of GNI. Maximize the budget impact. With over 50 programs, the current EU budget is fragmented, limiting its effectiveness. Consolidating programs around core EU priorities and shifting towards a performance-based budgeting model would enhance efficiency, improve coordination among member states, and better align national reforms with EU-level objectives. And the final part of this 3 recommendation: strengthen the financing through enhanced own resources and borrowing capacity. Establishing borrowing as a regular financing tool backed by robust own resources for repayment would enable more strategic, long-term investment while spreading the financial burden more evenly across time and member states. Now, the 4th point I want to make, that a more integrated Europe is also a more resilient Europe. And I think that's an important message. Growth goes together. These reforms of integration go together with generating productivity and growth and make the European economies more resilient and more robust, including to external shocks. The spike and volatility in energy prices following Russia's invasion of Ukraine, along with last month's blackouts in Spain and Portugal, underscore the urgency of a coordinated European energy policy and establishing an integrated energy infrastructure. On the financial side, advancing the capital markets union would not only channel savings into productive investment, but also facilitate portfolio diversification and significantly improve risk sharing across the union. Fiscal policy, particularly the EU budget, has an important role to play in supporting energy integration and risk sharing. Let me conclude by stressing that Europe stands at a critical junction. The world is changing, and Europe must once again demonstrate its ability to step up and deliver. Strengthening and, yes, even upholding prosperity requires a decisive and concerted effort, reform push at both domestic and EU levels that enhances growth and resilience while maintaining openness to the world. It is time to act now, and it is time to act together. Thank you.
Thank you, Alfred. This was quite a tour de table, let's say, to try to summarize broader fiscal issues with kind of product, services, markets, adjustments in one speech and in 50 minutes. So if I can invite Cinzia to come to the floor and Martin, and then, of course, from their part to react onto that. But, of course, to the audience, I say we will have in a moment also time for Q&A. We want to finish about 6:15, so we'll have time enough, let's say, to have reactions. But, of course, we are very happy to have Martin here to react as Director General of DG ECFIN, DG Economic and Financial Affairs. I mean, probably you're the first in line, Martin, to react to this speech and to see how you see it from your perspective, how DG ECFIN sees it from its perspective. But also, I mean, as we hear, I mean, there's a lot of uncertainty around. we've seen, let's say, over the last weeks, the markets recovering from this extreme uncertainty around the announcement in the United States. How do you see it from your perspective? Is it not as negative as we see? But I hear also that Alfred says, let's say, there's a considerable difference between the prospects for the Eurozone and the prospects for the EU or Europe as a whole, as you define it as the IMF. Huh? Martin?
Yeah, this works. Great. Yeah. First of all, thank you very, very much for having us, and always a pleasure to be together with Alfred or any other colleague from the IMF in the panel. And one of the reasons for that is actually that we tend to agree these days on most of the issues. That's not always been like that, but these days I think there is a lot that we agree on, and I would agree that the tour de table of Alfred was very complete. It covered both the medium long run and the short term. And in my reaction, I will mostly focus on the short run, and I think later we may come back a bit to more the structural issues. Now, the reason why I would first want to say something on the short run outlook is simply because today we published our commission spring forecast, and to cut a long story very, very short, in terms of the numbers, we are actually very close to what the IMF is projecting. And the dominant theme in our forecast is clearly the trade uncertainty caused by the rather erratic policies in the US. So it's the trade restrictions, but in particular, I would say the exceptionally high policy uncertainty that is already weighing on both on trade, but also on investment. So we expect the EU economy still to grow moderately with 1.1% in 25 and 1.5% next year. For the euro area, it is indeed slightly lower, 0.9 and 1.4. Now, this implies this is still, it's moderately, but it does imply a cumulative loss in growth compared to our autumn forecast of around 0.8% of GDP. Now, if you look at what is causing that is actually only a relatively limited impact we see in the actual tariffs that have been put in place so far. Now it's not exact science, but let's say that can account for maybe 25% of that, whereas the rest of this loss in growth is mostly uncertainty and also the resulting tighter financial conditions that we see. Having said that, labor market continues to perform actually rather well. It has been like that for a couple of years. Job creation and rising wages continue, albeit at a slower pace. We also see vacancy rates coming down somewhat, whereas we see productivity recovering, which is very much welcome. We see inflation falling faster, which is in Europe. This is the impact of. We have the reverse impact in a way of tariffs as the US, where in the US it's more a supply shock. In our case, it's more a demand shock. So for us, it means somewhat lower inflation, and we expect the ECB target to be reached already this year, and we see as an important driver of that lower energy prices. Now, on the fiscal, we see that becoming less restrictive. But I have to say, we see deficits slightly above 3% for the EU, and also for for the euro area, and we see after some a period of decline, we see also the growth edging up again. But we do not see yet the effect of the triggering of this national escape clause, and we may come back to that later. Now, risks, they are there, as always, more to the downside than to the upside, and they relate mostly to the tariffs. Now, I would like to make use of this opportunity also to point to some analytical work that you will find in the forecast. There's first we have a chapter looking at in more detail at the tariffs. Now, I will not go over it, but the main points there is that the direct impact, as I mentioned before, the direct impact of tariffs on Europe is actually rather manageable, and in any case much more limited than what we would see in the US. And the reason for that is simply that the US is imposing tariffs on everybody, whereas we are only dealing with the tariffs on us. Now, so that is one thing, and I think in at least in our simulation that's a factor 1 to 3. So the impact on the US is actually a factor 3 bigger than in our simulations than on us. Clearly, if you add retaliation in that, and we have a scenario there, symmetric retaliation, it's a hypothetical scenario, I should say, that aggravates clearly the impacts on both our side and also on the US. Once you start to add in increased uncertainty and higher risk premia, then actually that amplifies further the effects. And again, we see a small effect of that on us, but actually a significantly bigger effect on the US, which I think may have been one of the reasons why the US hit the pause button in this trade, but the trade tensions. But the risk remain there. So one, if trade trade tensions are going to escalate, that clearly can bring down growth globally, but also in the US. Now, then briefly more, and then in reaction also to Alfred on the more structural picture. Again, largely in agreement with what the IMF is saying here, and if I would have to summarize, basically you're saying, look, you have a productivity issue, which we know. So we have been lagging behind in that respect. I think there's a lot of analysis done, and I think we all agree. We're all hailing from the same sources. I think, and the answer is, well, you have this big potential EU within the EU, so you need to integrate. You integrate more and deeper and faster, and you need to couple that with reforms and investment at the member states. And your instruments need to actually facilitate that. Now, we fully agree with this analysis here. The question is really not what should be done. I think we are very much in agreement on it. It's how it should be done, and that brings you more to the political economy of all of it, where I would hope, and with me many others, that the current circumstances and geopolitical circumstances as they have been shaping offers additional momentum to get the things done that we have known for a long time that they should be done. So let me stop here.
Okay, thank you, Martin. So more or less agreement between the IMF and the EU DG ECFIN, let's say, on the economic prospects. Probably the more difficult part, Cinzia, to look at product and services market, what needs to be done on reforms. I would say that Cinzia has recently done very interesting work as well on broader economic security, industrial policy issues, but also on kind of the way for the EU to follow in between the US and China, on which she has a paper on under the title Economic Security, which is on our published on our websites in the 30th of April. So, Cinzia, what do you see as part of the second part of Alfred's recommendations, and which direction should Europe go with the reforms, which we've heard for a long time, by the way?
Yes, many thanks. Thanks, Karel, for the question. And actually, I would like to highlight 2 points which follow directly on what Martin just said, and the fact that given the situation in which we are today and the increased global tension, disruption in value chains, and rising protectionism, actually offer somehow a compelling backdrop for to highlight the strategic and the economic value of the single market. And to explain my point, maybe it's let me go back to a few years. So the single market has been in place for more than 3 decades. I mean, if we take the 93 as a starting point, then we had the euro in 1999, and the process of integration actually took place. But somehow there was a sense that it was falling short of its full potential. This has been essentially the assessment over the last decades. And I think one of the reasons which could help us to understand why is the fact that these events were concomitant with an acceleration in globalization. If you think of the rise of China, liberalization, the division of the production systems and the value chains more or less happened at the same time as the European integration. And I think somehow this overshadow the potential of the single market. I mean, there was in the IMF regional outlook of October 2024, there is a nice chart where there is a comparison of intra-EU trade with the international trade, or the extra-EU trade. And basically, you see that it developed almost in parallel. So there is development in intra-EU trade, but at the same time also the extra EU. So in this sense, that there was this fact that the world economy shifted European growth momentum outward. Somehow for companies it was as easy to operate in the single market than at global level, or maybe even more at global level with new large emerging markets and cheap labor in some situation. And I think that today we are completely a turning point. I mean, the outlook is completely changing, and the resurgence of tariff, especially, of course, the United States, but also the fact that other countries are resorting to other trade tools. Think of export control that China has threatened and imposed in certain circumstances. All these basically point to a much greater uncertainty outside the EU. And in relative terms, and we know that economists and companies also think a lot in relative terms, this actually makes the single market a good place where to operate. So in a sense, that there is really an opportunity for the single market to shine. Assuming that actually we maintain this condition and actually we untap the potential. And I think this is both, if you want, an economic, but also a strategic opportunity given all the issues related to security, resilience, and so on and so forth. A second related point is really on the untapped potential of the single market, and the barrier that somehow we have to face. And I think there it's quite important actually to distinguish 2 types of obstacle, broad obstacles. One is, it comes, if you want, from the Commission. The Commission is blamed for over-regulating, for creating a system which is quite unfavorable to businesses. There's been a lot of lobby from the companies actually to reduce this, and the Omnibus package is basically the response to this, is the essential response to this. Now, we have to see what it will deliver. But there is another aspect, which was implicitly mentioned also by Alfred and also Karel. And one critical obstacle to the full functioning of the single market is the obstacle to scale up businesses. So the fact that when it comes to operating in the single market, very often there are 27 different markets rather than a single one. But in this case, the main obstacle is not the European regulatory framework, it's the national. It's the fragmented, the heterogeneous framework which exists at national level. And this is can be related to national civil code, commercial code, or specific regulation on which, let's be honest, there is not much appetite for giving them up and to move towards a single system. I mean, the usual example is really the insolvency system and the fact that basically we have 27 of them. So the proposal of the 28th regime, again, is an attempt to give a response and to overcome the lack of political willingness. It's not the first time that we have a similar proposal. It didn't work. It's probably not the last time we'll have this kind of proposal. Let's see if it works. But again, this is a way the Commission is trying to overcome somehow the lack of this political willingness at country level to overcome differences, which it has a justification. It's not just out of the blue. It's a way to protect some national champions or to keep some systems which have been in place for a long time, and so that there is a certain inertia. So I think this remains a fundamental question where the key is actually the political willingness, and this may be make the switch to the gains that Alfred mentioned earlier. Thank you.
Okay, thank you, Cinzia. Thank you for pointing out to these problems which we have above all at the national level and the unwillingness of member states to move, and that's what I hear also a lot in the European Commission. That's what we see a lot as well. Basically, the area I know best, financial services, there's plenty of gold plating. Basically, as soon as Brussels does something, I mean, there are things which add up. And Alfred or the IMF has come out with this figure. I mean, tariffs in the financial services sector are something like 100%, comparable to 100% tariff. So that is, a problem. And the issue is that we know this since a long time, and we have not really been advancing a lot. Let's say, like, for example, you mentioned the example of the electricity markets. We know this since very long, let's say, the differences in prices for electricity. We know the issues in capital markets since quite some time. It's just that we feel the urgency much more now. So, Alfred, what is your view? Let's say, what is feasible now, you think, to be done by the EU and above all by the member states? You think there is a new wind? Just by reference, we had Aurore Laluc here last week. She's the head of the Econ in the European Parliament. You had a feeling, or when listening to her, that there is a new momentum. You think there is a new momentum, let's say, for reforms now?
I certainly hope there is a new momentum. When two figures. In 1995, labor productivity in the US and advanced European countries was at par. Now it is 20% below US level. That has opened up over the last few decades. When you're looking at the root causes of this, you come always down to business dynamism. The ecosystem in the EU is not there to produce at scale, to operate at scale. And especially when you look at technology, that matters. That matters for innovation. And some of these elements which are available in the large US market, on the capital market side, on the labor mobility side, on the product and service market side, are just not there in Europe. This is, I would say, a slow-moving crisis. But the bottom line is that leads to relatively lower living standard than the EU should have. And why is this now becoming much, much more important? When you're looking at the long-term spending pressures, which you are seeing creeping up, age-related costs, healthcare, clean transition, the energy security side, and a long-term cost, which has suddenly advanced, national defense. So we estimate for advanced European economies over the next 2.5 decades, that adds 5% to spending pressure. For emerging European economies, that adds 8% to spending pressure. So you need to come up with sources of tackle these spending pressures. So if Europe wants to maintain its living standard, if Europe wants to maintain the social contracts in place, one of the levers to work with is growth. And the lever which is actually cheap. I'm not talking about more work. I'm talking about more efficiency, and that's productivity. I think what we are trying to do is, when you're looking at Europe, many countries actually don't realize at all the huge benefits they're already deriving from the single market, and also the huge benefits which are left on the table. And sometimes the narrative is wrong. When we are looking at business regulation, that's something where countries actually internally need to work on in terms of streamlining, simplifying reporting requirements, advancing, accelerating planning processes. When I look at Germany and when I look at Spain, our recommendation actually is harmonize differences between regions there. So this is not just a gold-plating issue through of EU regulations, and we shouldn't underestimate the big benefit of EU regulation. It harmonizes across, so it makes it easier for businesses to operate there. So bottom line is, we need to have action. Our suggestion: package EU-level reforms in order that everybody sees a win in those, and demonstrate that the single market actually is going to deliver. But what we are also adding is, don't forget that many countries haven't done any structural reforms over the last 15 years or so. And there's a lot to be said about these structural reforms on the domestic level. We calculated, we looked at the best performing countries in Europe, and all countries in Europe, and through in the US, and we did a frontier on best performance on labor market, business regulation, capital market issues, innovation, etc. And if you close this gap to the best performers, you have only by 50%, you get a growth dividend of 5% in the level of GDP. That's a huge number. And you only close it to the best performers by 50%. What we also suggest is, so not only EU-level reform, also national reform, and then look at complementarities, because they will amplify each other. When you're thinking about a business regulation, it needs to happen at the national level, and it needs to happen, and it's happening right now at the EU level. When you think about capital market reforms, if a country is working on strengthening and deepening its capital market, it actually is amplified hugely by a European level approach. So think about complementarities, but bring national reforms in. And their final point is, use the European budget to incentivize national reforms. We have a fantastic example with the Next Generation EU Fund, where support from Brussels was depending on action on public investment and structural reforms. And that helped overcome domestic political resistance to these national reforms. So think about it holistically, use the levers you have available, and as Martin said, this is not a question of disagreements on diagnostics. This is not a question of disagreement on policy solution. When we talk to European policymakers, there are no differences. But then we are stopping at the implementation because of political and vested interests, which are always difficult to overcome.
Thanks, Alfred. You made a very strong statement that most countries haven't made any structural reforms over the last 15 years, which is a very strong statement. Of course, can be true. I mean, if I look at some of your charts and if you look at the widening gap with the United States, and this has been widely around, not only by the IMF, but also by others, say that is a strong message. Probably turning to Martin again to see how he sees it from his perspective. I mean, we have adopted at European level the competitiveness compass. Is this tackled somewhere in there? Let's say, will we manage to do these as well, the European reforms, say the reforms at EU level, as the reforms at national level? Of course, reforms at national level is something which you have to have in your broad economic policy guidelines, which is not done by the EU directly, it's more indirectly. But of course, then the reforms at European level is many different DGs at European level. Are we now in a new momentum again to do this, Martin?
Yeah, a few points. Let me first react to Alfred. Where I would agree is that reform at the EU level has been very slow or largely absent. So that has, if it's about the savings, now called savings and investment union or capital markets union, banking union, not a lot of progress has been made over the past 10 years or so. And there are other areas where we have moved too slow. So that's second. At the level of the member states, I have to say the picture is a bit more diverse. Some member states they did do reforms, notably in the financial crisis. Others that were performing relatively good at the time were clearly more slow, and so there is an agenda there. Now turning to your question. So for the Commission, for this Commission already from the start was clear that there were two key priorities. One is improving the productivity performance or the competitiveness of the European Union, and the other is to move ahead on security and defense. Now, with recent events, and this has, well, it's now I think clear to most that we need to move. Indeed, the Commission has come forward with its competitiveness compass, which is basically outlining the strategic agenda for the next 5 years, which is very wide-ranging, and meanwhile also the Commission has continued to put on the table a large number of initiatives. So if the Clean Industrial Deal, the Affordable Energy Action Plan, the Critical Medicines Act, then indeed the omnibus proposals on simplification and so on and so on. So that's the third point that I would like to make. There's no lack of ambition at the level of the Commission. I think that is crystal clear. But we also know that getting an agreement with with the member states and then with the Parliament, that often is difficult, and it's not, I think, a matter of obstruction or not wanting to reform. It's just the fact that it's every member state and every parliamentarian, they all have their legitimate concerns on bits and pieces. The problem is if you add them up, then it becomes very difficult to move ahead, and that only works if you have a lot of momentum, and typically you need some outside pressure for that. Now, I think that is building, and then the question for me is more, okay, not so much can we make progress on each and every file, but on which files can we make progress, and on which files should we make progress at this point in time? And here I would say that probably it's easier to move on the argument, these are more defensive arguments, given the current state of the world, than abstract arguments around productivity. So where can we move, and where do you see movement? Now, clearly, we are seeing movements a lot in the area of defense cooperation and of defense investment. So that is very clear. I think where we see momentum now is also on the simplification drive. We have put on the table these omnibus. At least at the level of the member states, I think there is buy-in in this process, and there's more to come. Now we need to see how these packages look like once the whole legislative process is done. But I think I would expect things there. Logically, given from recent experience and also the external situation, I think it should be possible at this point in time to move further on the energy file. I think this is critical, and I say very often to people, look, if only we could fix the energy, even if that was the only thing that we could fix, then that would already be a major step forward. And I think it should be possible to make steps in that domain. And I think also increasingly people see the dangers of being completely dependent also on digital solutions, etc. So I think the short summary of a rather long answer is that yes, I do think there is momentum, but it will require a very strong impetus from the highest political level to make sure that all these legitimate concerns that come up in various committees that they are, I wouldn't say crushed, but that they don't hold up the solutions that are good for the whole.
As part of this ambitious agenda, before I turn back to Cinzia, first Alfred, but very briefly, you said you want to move to a budget of 1.8% of GDP, which is extremely ambitious, and which
1.7.
1.7 does make. I mean, we come from 1.1, so that's an increase of 60%. That's enormous. I think you would finance it also through the markets, as far as I remember. You think that is feasible? How would you sell this in Europe?
So, approach is the following. Europe needs to provide European public goods. Defense is now where the Commission and European member countries are moving. They're discussing how to go about it. Martin made a strong intervention on the same thing in the end needs to happen for another public good, and that is energy. And it's cheaper energy, reliable energy, and you need to have lower external dependence, second public good. And third, Europe needs to catch up on innovation. So there's another element where the EU budget can help with research and development. Now, as an economist, you would say if you have public good, everybody is going to benefit, and therefore you should fund this or drive this centrally. But it's more than just that. It is also the strategic approach and the coordination. And then what you also get is you get the cost savings when you look at it from a fiscal perspective. If everybody has a 27 energy strategy, 27 national defense strategies, 27 R&D strategies, that's highly inefficient and probably will not deliver on the overarching objective. So shifting the responsibility to the EU makes a lot of sense also on the fiscal side. So that's the starting point. I would go further on the and that requires so if you are starting with the premise, we need to pay for it. And Draghi pointed out this is the investment we are going to need in order to achieve the objectives. 20% usually is the number where you say this needs to come from the public side, so shift more of that to the EU. That is the number you were coming up with, and that is where we are approaching that. I think on the budget, we want to use it further. One issue with budgets, it's in every country, it's driving priorities. And what you can use the EU budget for also is to incentivize countries to do reforms on a national level. The NGU has proven that. And when you're thinking about cohesion funds, which are helping convergence, you could use a performance-based approach in order to provide these incentives for countries. And final point on the financing, borrowing should be part of the discussion because these are investments in the future. And that is therefore makes sense to borrow for these investments. But it needs to be clear that you need to be able to also service that debt. And that means we need to have a discussion on increasing own resources for the EU.
Better functioning capital markets as well, let's say, to do with this safe asset or part of the safe asset discussion. But anyway, you pleading for more Europe in budget. I hope the member states see it that way. But Cinzia has also done work on the RRF for DG ECFIN, by the way. Probably some takeaways from that, Cinzia, how you look at this feasibility to have a much bigger budget and then to look at the kind of the lessons from the RRF?
Maybe two points. Maybe I would like to distinguish the fiscal challenges at national level, where the EU budget as MFF can intervene, and then maybe to think of a different RRF for defense. So I think these are three different levels, not excluding each other, but they entail different assumptions and they have different implications. So let's start from the national level. I mean, it's clear that the demand for public spending is increasing quite dramatically. It's defense, it's energy security, which increases the challenges already existing, especially the demographic challenges and the twin transition. So if you have more demand for spending, the best solution would be to grow more, which is basically, Alfred, what you propose. When you have more people eating the pie, you want to increase the pie in order to preserve the size of the slices. Now, we heard the forecast, and the pie is not growing very much. So of course there is potential, but the working assumption is that basically for some governments there are priorities to be made and choices to be made. So there may be a sort of zero-sum game whereby if you want to spend more on defense, on energy security, you will have to give up on something else. And I mean, of course, there is quite a growing concern, for instance, about the future of the welfare state. I mean, here in Belgium, tomorrow it will be, I think, the 7th or the 8th Tuesday of strike in a row in the public sector because there is protest against what the government is proposing in terms of cutting social expenditure. So these concerns are becoming quite real. Now, what is happening? But the reality is that I think there is no single government which is putting forward the idea of I'm going to cut social expenditure to finance defense. This is certainly a no-go, but some adjustments are happening. Another adjustment that we are seeing is that at least that would be my assessment, is that some countries in a more subtle or explicit way are clearly backtracking on climate objectives. And this is basically using the argument that the other priorities are emerging. Some other countries are trying to use the fiscal room that the Commission is offering, for instance, through the activation of the escape clause to increase defense expenditure. As far as I know, I think 12 member states have requested, maybe more now, have requested the possibility to increase expenditure related to defense, and this not been considered for fiscal rules. But some other member states which have high debt have not decided to use this option because there is concern of how the markets could react. So there are some constraints which go beyond the constraints of the rules and which are dictated by high debt. So the question is, what could we do? And of course, one easy answer is EU budget. Now, I think that I start from the assumption that the size of the MFF is not going to increase. I'm sorry, I'm maybe based in Brussels, and given that the discussion, the negotiations are really they're starting to intensify. The Commission will put forward a proposal on 16 July, I think. So the talks, there are a lot of talks, a lot of discussion, but I don't know, maybe I'm wrong, but I don't see much room to increase the size of the MFF. And I think besides the size, I have two other concerns. I think we need to be very cautious with what are the objectives of the EU budget in the treaty. I think that the adjustments can be made in the direction of supporting some defense investment in research or innovation. But I think the purpose of the EU budget is quite different. We need to be very careful, given also the political context and regional heterogeneity in Europe, to not to make it backfire. That's one thing. The other concern I have about the MFF is actually the timing. So we are basically discussing now the EU budget for the next 7 years, starting from 2027. So, the debate about financing defense is actually very much an issue of today. Yeah? So this may be something that comes too late. And we're likely to be in a situation where in 2027, actually quite a lot of the current funds will not be used because there is a great delay due to the absorption of the RRF funds, which got priority. So I wouldn't be so keen or push for the MFF. But I think, and this I'm going back to your argument, actually defense being a public good would justify issuance of common EU debt. And in that sense, the RRF would serve as a potential template. But I think in this specific moment, there are also two additional arguments why using EU debt. And I know that political appetite may not be there, but besides the fact that in this case we are really speaking about a common EU good, there are two other arguments. One is that basically it could be the opportunity to define defense as common defense and not as a sum of 27 national defense policies funded by national governments. And the last one, it's more really macroeconomics. We are in a situation whereby actually there could be a good momentum for the euro and for euro-denominated assets. If you think of what is going on the global financial markets and the fact that there is a clear attempt by investors to diversify away from the dollar. There are not many alternatives, and the euro is certainly an alternative, and euro-denominated assets could be particularly attractive without making much effort from the European side. So I think these aspects, these three dimensions, really need to become part of the discussion about how to finance EU defense.
And of course, with the precondition that defense should be EU defense, not a combination or the sum of national defense, which preoccupies me a lot, certainly in the discussion about 2 or 3 or 4 or 5% for defense. And if you think 5% is an enormous lot of money. I look around for questions because we have already gone a bit over time. Let's say probably, the defense escape clause was already addressed. I see 3 questions. Andreas come around with the microphone. I think we'll take the 3 at once or the 4 at once, but try to be brief and have a question and try to see who you are, please.
Lucio Penk, Bruegel. I have a question of Martin on fiscal matters. This is the first forecast taking place after the member states are put forward, they are supposed to implement their medium-term structural plan. At the same time, as you mentioned, the escape clause intervened. So my question is the following. Leaving aside the effect of the escape clause, which, if I understood correctly from your question, is actually not, by and large, not taken on board by the forecast, are member states on track on implementing what they have committed to in the medium-term structural fiscal plan? The second part is about the defense.
Not too long, Lucio.
Now, is the defense escape clause. You mentioned, in fact, the result has been quite underwhelming. If we look at not at the number of countries, but at the weight of countries in Europe, basically all the biggest countries, except Germany, have decided not to avail themselves. Germany, looking at what has done, what probably have done, what have done, whether or not the EU would be had put in place. So what is your assessment of that? Personally, I've said, I was really surprised. This is the first time that the Italians don't avail themselves on an escape clause, and I have some experience on the subject.
Okay, your neighbor.
I'm Anna Kolesnichenko. I'm economy policy analyst at FEPS, Foundation for European Progressive Studies. My question is to Alfred Kammer. So we don't like Trump tariffs, but I think some issues that he is addressing are real, like imbalances, current account deficit in the United States, and dollar overvaluation and loss of competitiveness. So do you have recipes how he should solve this other than tariffs?
And then there is a question at the back and one there. We'll take all four at once at the back. Yes.
Thank you. Luc Dres, National Bank of Belgium. I have a question for Alfred. So in the short term, uncertainty related to US policy is large. Maybe in the medium term, the structural aspect will be also dominated by US related uncertainty. I mean, energy with the drill baby drill of deregulation, financial sector and digital data. How should Europe respond to this in the medium term? Should they adjust the structural program if something happens there in the US? And it's also related a little bit to competitiveness, to external competitiveness of Europe. Thank you.
Interesting question, but a tricky one. I mean, and a final question there.
Thank you very much. I'm Anna Björnmark from the Swedish Permanent Representation. And I have a question to the IMF, and that's regarding now ideas that are floating around in Brussels about buy European. And we see this not only in the defense area, but also more generally regarding public procurement. It's even mentioned in the context of saving and the investment union that to sort of put up barriers where savings from the EU can be invested. So I just wanted to hear your reflection on risks with that and potential costs. Thank you.
Okay, can we start probably with Martin on the defense escape clause and its implementation and what member states have done? I mean, Cinzia said something about this, Martin. Oh, you can react upon that, what Cinzia said as well.
Yeah. Okay. Now, first on, I'll start with the second point, and just to recall what the escape clause does and what it doesn't. It allows members. It's something that allows member states to do. It doesn't say you have to do it, but it gives the allowance to do it. The allowance in this case, it's to spend, to exceed your expenditure limits if that money is used for the defense expenditure within clear boundaries. Now, I wouldn't necessarily say that this is underwhelming, because the big thing here is, I think, quite frankly, that Germany is now stepping up, and I don't think that is a small thing. I think that is actually a pretty big thing. Now, you're right that a number of bigger countries, you mentioned Italy, I could mention France, they have not availed themselves of this possibility, and I think the reality is that they are very mindful. I think also of their position or their fiscal position. Now, that is not to say that this will not come, because also later there's still a possibility to trigger the national escape clause. But I think that these governments, at least at this point in time, have made are following a rather cautious approach, not to trigger, also to avoid reactions on increased borrowing costs, etc. So I think, but to be seen. So but I think the overall, I would not share your categorization that this is underwhelming. Now, on your first point, here we are still we're still in the process of assessing what member states have done. The member states, they are submitting have submitted their annual progress reports. I think so. We'll come in a few weeks with our assessment of where they are. So I don't want to speculate too much on that now. The one thing that I would like to point out, though, is that the reason why we have not yet taken into account the effect of this triggering of the national escape clause is essentially the no policy, which you know very well, the no policy change assumption that we use in our forecast, where we can only take measures into account if they have been announced with sufficient substance to it. And when it comes to the fiscal plans, and in particular or when it comes to the defense plans, we simply do not have enough at this point in time to say to assess what the impact on the fiscal already this year will be. More generally, we would expect this to come gradually in the 4-year period because of the normal lead times for this type of expenditure. Thanks.
Alfred, on imbalances, or say whatever may be the benefits of what's going on in the United States, and on the financial reform?
Yeah. On the global imbalances, so we have been arguing for a while that policy action should be taken on those. And recommendation to Europe was more investment, more public investment is required. I think the NGU has contributed. Germany is doing a big step forward. So that's the right way to go in terms of contributing for Europe to bringing down global imbalances. Our recommendation to China was to shift more to domestic consumption. And go away from the export investment-led model. That's something I think which needs to be also implemented. And advice to the US was lower the fiscal deficit. That is also a long-standing recommendation for us. So all these three together would address and lower global imbalances. Second issue on how should Europe behave, if I understood you correctly, Luke, on in a fragmented, more hostile world environment. Just to point out advantages Europe has already. Europe is an innovation center. Europe is a manufacturing center. When you're looking at the US, it is strong in innovation. It's not strong in manufacturing. And when you're looking at China, it's strong in manufacturing and it's just growing on the innovation side. Europe already has both. And our recommendation was if you want to increase resilience, you need to utilize the advantages you have already. And that is through the single market. You need to get this ecosystem going. You need to get rid of your barriers so that your innovation and your manufacturing can work together and thrive. So that is an answer to the question of what Europe should focus on. When it comes to energy security, if you want to lower energy dependence, it is to moving forward with renewable energy. That is going to lower energy costs, but you also need to have a system in place that you have a reliable grid in Europe. So those are things which are building productivity and growth, and those are also things which are building resilience and make Europe more robust to external shocks. And to your question on this one, that's the right response. And when it comes to trade, more trade is better. And because trade improving the efficiency, it helps you be more productive. And if you are diverting away from trade, you buy yourself into a lot of inefficiencies, and it's going to result in an income loss. So if you want to fix things, use the single market for growth and resilience, and you want to move globally in order to defray tensions between the biggest blocks on the economic side, we need to reduce global imbalances, and there we had long-standing policy recommendations which Europe now is moving on, especially with Germany making a real push on the infrastructure investment side.
So, Alfred, if I paraphrase you correctly, I mean, try to complete the single market as a kind of an alternative to the trade tensions which we have today. Meaning, try to benefit from what we don't have enough as a single market as a kind of response to the uncertainty we have on the global scene.
Yeah, I would put it both ways, and I want to have it both ways. Yes, this is going to help in terms of dealing with external shocks, the current ones, but also the shocks which may be in the future. And irrespective of external shocks, this is money Europe leaves on the table. And why leave that on the table if per capita GDP could be substantially higher with more efficiency? So Europe should do that irrespective of what happens externally, but it's certainly going to be helpful of dealing with external shocks.
Maybe final question to Cinzia. You think this is likely from your perspective of also over 20 years in all these matters?
I'm actually quite optimistic. One of the few things on which I'm quite optimistic. And as I try to argue that at the beginning, I think that the external environment has become so unfriendly that the single market is not an opportunity. I think it's a necessity. And I think policymakers will have to realize this. So on this, actually, I tend to be quite optimistic. It's not for the right reasons. I mean, of course, I think that the obstacles to global trade are going to reduce global income. So on this, I have little doubt. And I mean, when I see markets basically becoming particularly positive because we have tariffs at 30%, actually it looks quite crazy compared to 2 years ago. Of course, if the term of comparison is 145%, it's fine. But still, these tariffs are very substantial. So, and this will have a hit on the global income. But when it comes to the internal market, I think somehow all these unfriendly elements could work positively for the single market and, as I said, for the euro. But I think we should not miss the opportunity.
Okay, and with this, I think we can conclude this session. We have gone a bit over time, but I think we had a lot on a rich debate and also interesting questions and answers. So let me thank Alfred, Martin, and Cinzia, and thank all of you for your attention and also our staff.